Hey folks, Ashley Garner here. So what's on my mind today? You probably saw the mention of the potential of a 50-year mortgage, and with the purpose of stimulating the housing market in the United States. And of course, this isn't anything that's a real thing yet. It's just discussion. And I think it's good that there's a discussion about this because the affordability of housing in the United States problem, and it's definitely something that needs a solution. Whether the 50-year mortgage is the solution or not is probably up for discussion. My feeling is that it's probably not the solution, but let's talk about what it is and how it would affect things. So the one and only benefit that a longer amortization period, and the amortization period is the amount of time that you're borrowing the money for, or so that there's a calculation to determine the monthly payment. The amortization period is the length of time. And so a longer length of time, everything else being the same, results in a lower monthly payment. Okay, so then the idea is, well, if the payment is lower, then more people can afford to buy houses, and so they'll buy instead of rent. Now, is that really what's going to happen, though? That's what we need to talk about. Let's look at this chart up here on the whiteboard, and then let's talk about some of the finer points, all right? So I think you can probably see this, but we're talking about the example that we've got up here is a $512,800 house. And why I picked that because that's the average sales price in the United States right now, okay? Now, the average down payment's 18%, but I went ahead and used 20% for easy math. And most people just kind of associate 20% down payment with purchasing a house. So that if you put 20% down, you still have to have $102,560, which is a lot of money. By the way, the 50-year mortgage just by itself doesn't address the down payment. So if you put that 20% down, then you borrowed 80%, that means you're going to borrow $410,240. Right over here. Sorry, I moved the camera out of the way. And then the average rate right now is 6.15. Now, that's also up for discussion because normally the longer period of time you borrow the money for, the higher the interest rate. For example, on a 15-year mortgage, the interest rate is normally much lower or significantly lower than it is on a 30-year mortgage. So we can assume that if there's a 50-year mortgage, that the interest rates on the 50 is going to be even higher than the 30. We'll get to that in a part. All right. So let's look back at the chart. So you got the monthly payment, you've got 30-year mortgage, 50-year mortgage, and then right here you've got the delta, okay? The delta meaning what's the difference between the 50 and the 30. So on the 30-year, you can see that the payment is $2,502, and on the 50-year, you can see the payment is $2,126, and that's a difference of $376 per month to the good, meaning if everything else is the same and you just borrow the money for 50 years instead of 30 years, that your monthly payment is going to be $376 lower, which means that you can finally afford a house or maybe afford a bigger house or a more valuable location or whatever. That's the idea. If you go here, this is where we need to talk. This is where it gets interesting. And, you may not know this right off until you do the calculation. The total interest that's paid over the life of the loan. Now, this is if you borrow the money and kept it the entire time, the term of the loan. If you had a 30-year loan, your total interest pay would be $490,000. Now that's on top of paying back the money that you borrowed, $410,240, but you're going to pay that much in interest, so almost $500,000. If you borrow for 50 years and keep it the whole time, you're going to pay $865,360. Okay. That's a difference of $374,800. So almost $375,000 costs you more in interest to borrow the money for that long. That's astronomical. Now, here's the other thing. Balance after 10 years. So say, you move into the house and you want to sell it after 10 years, move to something else. Well, you've got to pay off the balance of your loan on this house before you can move on to the next one, right? So if you bought your $410,000 house after 10 years with a 30-year mortgage, your balance would be $277,384, okay? But on a 50-year mortgage, your balance would be $348. That's $70,000 higher, meaning that's not a good thing. That means you still owe that much more. So The bottom line is this: it's going to cost you a lot more in interest to borrow the money for that long. You're going to pay much less down towards your principal each month. So the portion of your monthly payment, which in this case on a 50-year was $21.26, if your monthly payment is that much each month, then part of it goes to principal, part of it goes to interest. On a 50-year, the part that goes to the principal is much, much less than the part that goes to principal on a 30-year. So each month you're paying your payment. Most of it is going to the bank in the form of interest, and less of it is going to pay down your loan, which means you still kind of owe more. Again, overall, the end result is that it costs you a whole lot more to do this. So let me look up here something on the screen. So let's talk about these implications. I think the largest part of what people are trying to solve for is that housing is expensive. It costs a lot to buy a house. And so more people are renting houses. Now, while that may be good for landlords like us, we have a constant, solid supply of tenants because of this. Because overall, the rule of thumb that we always use is it's still about triple the cost to own a house than it is to rent. Meaning, if you factor in, the taxes, the insurance, the maintenance, blah, 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 everything that it costs you to own the house versus just paying the rent, it's still like triple the cost to own the house than it is to rent. Now, you don't get to amass your wealth. You don't get to increase your net worth, if you will, if you're just renting. And that's another thing that people are trying to change. But the bottom line is people would like to see housing more affordable. So you say, well, let's come up with a new way to borrow the money that makes it less costly, right? And so it's more affordable. But is it? Because again, if you were to take our example that we ran on the board and you put what actually would be the interest rate, it would be higher than a 30-year mortgage. So any increase to the interest rate just whittles down that delta to the good. In this case was $376. Your payment would be $376 lower a month. Well, it won't be that much lower because the interest rates can be higher. So is it even worth it to begin with? What would you have to keep the interest rate in order to make the payment low enough to matter? The other thing is the down payment is what's really hard for a lot of people to get, to qualify for the credit and then to somehow save up or be gifted or have the down payment, $102,000 cash money to close the deal. That's a lot of money. And in this example, and in the talk about the 50-year mortgage, there was no talk of lowering the down payment. That's really kind of one of the main things that needs to happen, in my opinion, is that the down payment's got to be lower somehow to entice more people not to entice, but to allow more people to be able to borrow the money. So you got to address that. Then here's the other thing. It's all supply and demand, okay? It's all supply and demand. If there is a shortage of supply, then the prices will go up, okay? And we have been, and we are, and we will be for a long time, I'm sure, experiencing a shortage of housing. So when that happens, prices just keep going up. The demand is there, the supply is not. So what do you think a 50-year mortgage would do? Well, a 50-year mortgage, if it does what they want it to do, would increase the demand for housing. And if you increase the demand without increasing the supply, then guess what? Prices go up. Now, if you run that equation and that example up there, and somehow you were magically able to know, hey, housing prices are going to go up X amount because of the 50-year mortgage, and you ran it at that new average price and it was higher, well, guess what? It eats away any affordability that was gained by the savings on the monthly payment. So again, your heart may be in the right place by doing a 50-year mortgage, but the end result would probably be increased demand for housing. And if there's increased demand for housing, that means the prices are going to go up. So what you always come back to in this is that the real situation, the real answer to affordability in housing is what? It's increased supply. You've got to increase the supply in order to get prices to be more affordable. And it's not as easy if there's you grow more corn and increase the supply, or you make more widgets and you increase the supply. Housing is tough to increase the supply. It takes a long time. It's expensive. And we're looking at, by the time a developer or a home builder goes out and identifies a 100-acre piece of ground that they're going to build a new subdivision on, and they find it and they buy it, and then they have to go through most likely years of entitlement, meaning surveying, planning, things like that, to get the permits in order to be able to begin construction, it's a lot of times it's years and it's very expensive. Now, once they get that, then they can begin building houses. But even building a house, is going to take, say, 9 to 12 months or something. And you can't just build 30 at a time. You have to stage them and do all that. So my point is this. It's very slow to add supply to housing, very slow. And if we're already behind by decades, then how can it happen overnight? But that's what people need to be focusing on. They need to be focusing on how can we provide more housing? Then you can get the supply up and the prices down, and now you have more affordability. But a 50-year mortgage most likely is not feasible. Most likely any potential savings is going to be wiped out by what banks are going to charge for interest rates and or the increase in the price due to the increase in demand. But I enjoy talking about it, and I think it's good that we talk about it, and it's good that we brainstorm and keep an open mind. Is it the answer? I don't think so. I'd be interested to hear what you think. Maybe I'm wrong. My wife, according to her, I am wrong every once in a while. But anyway, leave a comment if you've got a comment, or let's have a dialogue about it. I'm all about making it more affordable so that people have a place to live. All right.